Hi, thank you for joining us. I'm Grace Cavantis, and I have Mike Eklund with me, and we are going over Financial Symmetry's quarterly market update for the first quarter of 2023. We do these every quarter, and per the next slide, we want to let you know that this is not giving any specific investment advice. This is informational only. So if you have any specific questions about your financial situation or your personal portfolio, feel free to reach out to your Financial Symmetry advisor, or feel free to contact or fill out the contact us form on our website if you would like to talk with one of our advisors. With that, Mike's going to get us started off with talking about how the markets did last quarter.
Thank you, Grace. Yes, the stock market had a good start to the year after a very challenging 2022. You can learn more about what happened in 2022 through our first quarter market update on our website as well. We've been doing this, I think, for 2 or 3 years now, so you'll be able to see kind of the previous iterations of our market update. But as you see here on the screen, it was a strong start to the year for stocks and bonds, and we're here recording now in mid-April, and it's continued through mid-April as well. A couple key takeaways is we continue to see international developed stocks have outperformed U.S. stocks again. They outperformed them last year and they continue so far in 2023 as well. And then the bond market, which had a very difficult year in 2022, has had a strong start and has been positive so far in 2023. So I'll pass it off to Grace, who talked a little bit more about stocks versus real estate.
Yes. A lot of people have been very curious about real estate as an investment option, especially over the past few years, because we've been seeing really strong growth in the real estate sector. And so we wanted to have a quick slide on that because we've been getting a lot of questions on, should I diversify by investing in real estate as well as stocks or whatever other options there are out there, which there are many. And so Mike had a graph put together for us that shows the long-term results of real estate versus the stock market, also versus inflation. And so what we can see by this graph is that historically, real estate has just outpaced inflation, which is good, but the stock market in a well-diversified portfolio has exceeded inflation by 3 times. And so this gives some perspective on looking at real estate as an investment option versus really just sticking your money in companies that are going to be innovating and growing and looking to earn money over time. So if you're interested in real estate, check out this slide. We also recently posted a blog post that talks a lot more in detail about what it might look like if you invest in real estate. There's the link for it on the screen that Mike's pointing to. So if you want more information, please check out that blog post and feel free to send us any questions you have. Overall, the takeaway is stocks and bonds have had better returns long-term, and that there are probably some different, but maybe more risks when investing in real estate.
Yeah, thank you, Grace. And Grace was the author of that great blog. So if you have questions about rental real estate and is it right for you, I highly recommend checking out her blog post.
Thanks, Mike.
So the next page, I think, is really kind of the key takeaway here is looking at savings versus investing. This was prepared by a blogger that does, some very good information called Wealth Common Sense. But the key takeaway here is if you're saving money, and if you're not stopping working in the next few years, it's actually better to be saving and investing when the market is down. I always like to use the shopping analogy, saying, would you rather go to the store and buy when things are 50% off or 50% more expensive? And so a good example of that is during the 1970s, it was a very bad year for the stock market, returned about 6% per year. And so historically, that was below average. But then we look at the people on the right graph here who invested during the 70s and then let their money grow for another 20 years until the year 2000. Their money would have grown to about 8.7 million. So the benefit is they bought at lower prices and then let the money grow during when the markets did well, ended up with a much larger ending balance. Versus the flip side, as many folks may remember, in the 1990s, the stock market was very hot, it was very popular, and was a great time to be an investor because you saw very good returns. The challenge is the next 2 decades, the returns were not quite as strong, and so your ending net worth or ending balance was much lower. So you were buying high during the 90s, and then as a result, the balance was much lower. So as noted down here, painful time for investors is a glorious time for savers. So just keep that in mind. So I'll pass it off to Grace for the next slide, a little bit more on international stocks.
Yes, I know we've chatted about this on quite a few of our market updates, but until more recently, we've been seeing that US companies or stocks have been growing at a higher rate than international companies. And that's been a trend for about 10 to 15 years until about the past 18 months when international has now been growing faster than US stocks. And so the graph here just shows that when US returns are lower than normal, the international market outperforms 95% or more of the time. And so this chart clearly shows us the benefit of global diversification.
Yes, thanks, Grace. It's always hard to stick to a plan when you see a part of the portfolio not doing well, but I think the international stocks have actually been a positive trend over the last 18 months or so. The next slide is about a recession and investing. So if you listen to the media, a lot of talk about, I feel like this is the most talked about potential recession in history. Everyone is expecting when a recession is going to start and how bad it's going to be and what it's going to be like. What this shows is over the last century, I think there's been about 15 recessions in the US. In 11 of those, the stock market was positive 2 years after the start of the recession. So in a lot of these situations where they were positive even after the recession started. So there's no guarantee that a recession will result in a negative stock market performance. If anything, the results show that it's better to stay invested, stay the course, and your long-term results will be better than trying to time the recession, because as a reminder, the market is forward-looking, so it's already priced in the potential impact of recession in the future. So just keep that in mind if you try to think about recession and impact to your portfolio. And hand over to Grace, talk a little bit about different sector performance over the last few years as well.
Yes, so we've already talked about US versus foreign as two different areas to diversify between, but there's also different sectors within countries to look at. And so in prior years, we've gotten a lot of questions about technology. Should we invest a lot in technology? And there's been different times when energy was what was being heavily looked at and wanted to be invested in heavily. And during the pandemic, we saw that, or we were hearing a lot about tech, that was going to be the new place to put all your money. It was the best place to be. When inflation came, it was talked about as energy being the best place to be. And we've seen that the result is that they had about the same returns over the last 3 years, just with different paths. So this helps show us that, yes, we want to hold some energy. Yes, we want to hold some technology, but we don't want to put all our eggs in one basket.
Yeah, no, that's a great point, Grace. It's hard to kind of pick the next winner. And you see here, it took different paths, but they ended up at the same place.
Yeah, it would be nice if we could just have a crystal ball and know exactly which one's going to be the best and exactly when. But unfortunately, no one has ever been able to do that consistently.
And before handing it off to Grace for the kind of the final slide, this is a reminder, we've shown this before, but this is Financial Symmetry's 3-step investment process. I'm not going to walk through it today in detail, but if you are a client, you can talk to your advisor for more information on how this impacts your investment plan. Or if you're a potential client, we'd be happy to walk you through how this would impact you and our investment philosophy. So with that, I will pass it up to Grace to kind of wrap it up with our contact information and next steps.
Yes. Thank you so much for listening along with us on this quarterly market update. If you have any questions, feel free to reach out to us. We'd love to answer them. And all of our previous quarterly updates are available on our website under market updates. And if you have a financial symmetry advisor and are curious about any of these topics, please reach out to them. They're happy to answer your questions. And if you are not a financial symmetry client, but have questions for us or would like to become one, you can fill out our Talk to an Advisor form on our website. Our contact information is here on the last slide. And with that, we'll see you next quarter.